Welcome to the Sunshine Coast Real Estate Podcast, your go-to source for all things real estate on the Sunshine Coast of beautiful British Columbia. Whether you're a first-time homebuyer or an experienced investor, we've got you covered. And now your host, Nathan Demers.
Hello, fellow Sunshine Coast real estate junkies. Today's show is all about the Manulife One. Manulife One is an all-in-one type banking product that combines your mortgage, your day-to-day checking account, your savings account, and a home equity line of credit all into one big, beautiful account. With the Manulife One account, you can literally save thousands of dollars in interest and shave years off your mortgage. There have even been cases of people shaving as much as 10 to 12 years off their mortgage. It's one of those mythical things you hear about, and you kind of wonder if it ever really exists. Well, on today's show, we have Janice Shuster from Manulife to tell us a little bit about how it works. Janice has been in the banking industry for a gazillion years, and she's an expert when it comes to this product. Public speaking is not in her job description, but she was gracious enough to come on the show and tell us a little bit about how this works. So welcome to the show, and tell me a little bit about yourself. Tell me your story.
Thanks for having me, Nathan. I really appreciate the opportunity. So I've worked in the financial services industry my entire career. I started off in sales, been a mortgage broker. I've done mortgage underwriting for a couple of different companies, and currently in my role as business development manager for Manulife Bank. And on a personal note, I've been married for 25 years. We have 3 amazing daughters, as well as a couple of dogs. So it's a pretty full house, but lots of fun.
How old are your kids?
21, 23, and 25.
All grown up. Okay, I've got 4 kids.
Oh, wow.
So my next most important question is, does it get easier?
Yes, but it does take a while.
Does it get more expensive? My God, I can't believe what it costs.
It definitely gets more expensive because they eat more and they're all at home.
Yeah. I remember before we had kids, I was like, my wife and I were talking about it, and I remember thinking, like, I'd heard that it was so expensive, and I thought, it can't be that expensive. Like, I'll just make big pots of chili or something. It'll be fine. Not realizing that it's like, you need a minivan, you need a bigger house, you need way more clothes, you need food, all of it, energy bill, like everything. It's so crazy expensive.
Well, and then of course, they want to come with you when you go out for dinner, but then who picks up the tab? Mommy.
Oh my God. Every time we go out for dinner, and you can't go for dinner with 4 kids without having a couple of cocktails and survive. So every time we go for dinner, it costs like $200 at least. It's brutal. So we try to do that not so often. We're walking distance to a great restaurant here too in town. Oh my God. Terrible. All right, I digress. So tell me about the Manulife One. That's the famous Manulife One product.
It is the famous Manulife One. It's been around for a long, long time. A lot of people don't know much about it. And the whole purpose of the Manulife One is really to simplify your banking needs by combining your checking, your savings, your mortgage, and your secured line of credit all into one. And when you consolidate your debt at competitive interest rates, use your income and short-term savings to reduce your balance, you can take years off your mortgage and save thousands in interest costs. If you think about how a typical HELOC works at regular banks, you receive a monthly statement once a month, and you either make the minimum payment or whatever you have budgeted for. With the Manulife One, every time your payroll is deposited, you immediately reduce the balance in the main account and subsequently reduce your interest costs for the period of time the deposits remain. So it's instant interest savings. In addition to that, by maximizing the limit on the main account, you also create greater flexibility. In this high interest rate environment, cash flow is top of mind for most Canadians. And by consolidating higher interest debt, such as credit cards, car loans, you also improve cash flow.
So basically, because the cash is sitting in your account, it's working against paying down that mortgage, paying off that interest on a daily basis, as opposed to sort of sitting in your bank account waiting for your mortgage payment to be made, like would happen with a traditional loan.
And when you think about it, most banks, the clients will keep money in their checking account and they're being paid maybe 0.5% interest. So think of that money going towards paying off higher interest debt. In the long run, you're going to pay way less interest.
Okay. And so it's really for somebody that has some extra cash at the end of every paycheck. When you say, like, I think it was you that once said, it's for people that have more money at the end of the month than more months at the end of the money.
That's exactly right.
Right.
Yeah.
So if you're the kind of person that, spends all the way up to the limit, then maybe this isn't the best product for you.
No, it would not be the best product. We would then recommend that you just go for the traditional select mortgage, which we also offer.
Okay. And you can structure this to have multiple different accounts, right, for organization purposes. Can you give me some examples of how a person might structure that for simplifying their lives?
Yeah. And so with the Manulife One, the standard Manulife One, you can have up to 5 separate tracking accounts, 5 separate sub accounts. So meaning you could have anywhere from 1 to 5 year fixed terms with different amortizations, depending on what suits your needs. You can also have to 15 tracking accounts as part of the main account, which is the home equity line of credit. And the real benefit of that, and we're the only ones that offer up to the 15 tracking accounts, if you have like a savvy investor, somebody that's wanting to take money out, invest in the marketplace. Right now is a great time to invest because investments are down. We know, as everything, investments are cyclical. So now is a great time to invest. You can take a certain percentage, let's say 50,000. You name that as a separate tracking account, and it will track the amount of interest outside of any other debt that you're paying through that account. So at the end of the year, you have the exact amount that you can use towards your income tax payments.
Perfect. It makes tax time a lot easier.
It does. And the other thing that we also see too is parents more and more are lending their kids down payment money. And in this instance, they can do the same thing. They can have a separate tracking account so they can track that interest. Whether the kids are going to pay the interest back, I don't know, but they do have the opportunity to track it.
Yeah. Okay. So theoretically, you could have, say, 3 different rentals and then have 3 different sub accounts, pull that money out from those different accounts as a down payment on another rental, and then track that interest at tax time, as well as any expenses could come from that account as well, I suppose, and make that so much easier.
Yeah. And then the statements that you receive are very detailed. So there's a separate page for each tracking account and a separate page for each fixed rate sub account. So it's really easy to keep track of the separate investments.
Okay. So now I don't actually know the answer to this. What if you wanted to have a savings for, say, a vacation fund? Could you set aside a separate fund for savings for that account? And would that cash that was sitting there, would that be applied against the interest on the HELOC?
Let's just say if you wanted to put a separate savings account, and now let's say you don't actually owe anything on the HELOC, then you could do a separate tracking account and save money. And it's considered a high interest savings account as well.
Gotcha.
So we pay a premium interest when you don't owe anything on the home equity line of credit.
I see. So could you have one sub account where you owe, say, 20,000 and another one that's plus 10,000?
No.
Okay. So it would be like, I get it.
Sorry. Yes, you can. Yes, you can, because you would have a separate one, which would be a positive balance. And then the separate one, you just have to make sure that you're going to separate them as a separate tracking account.
I see. So the one that has a positive balance, that one will be gaining you interest over time.
Correct.
Okay. All right. And what's their interest rate currently?
I think it's around 4%.
Okay. So then my next question is, do you have a separate program for rentals?
We do. So we have what's called the Manulife One investment program. And for a subject rental, whether it's a purchase or a refinance, we do 50% add back of rent, and then we remove taxes and heat from the ratios.
Okay. So that makes qualifying easier.
Now, if it's a non-subject rental, we actually have a very unique rental worksheet that's very different from most lenders. So we allow 100% of the rent, and then we use expenses, whether that's off of the T1 General, or if it's a new rental, set expenses. And what makes us different is if there is a shortfall, we subtract it from income versus making it a monthly liability. So if you have a fairly large shortfall, it gives you a lot more room to qualify if you're just subtracting it from income or you're adding a large monthly debt to your liabilities.
Okay, so if you have a portfolio of properties, then that makes it sort of even easier to qualify for the rental program. Okay, gotcha.
And just one other thing that we see family members that will buy a rental property together. So let's just say we've got 2 applicants, but one of the applicants is not on the application, but they are part of that rental program. When you fill out the rental sheet for the non-subject, we'll use 100% of the rent, but we'll only use 50% of the expenses.
Oh, okay.
Because the person on our application is only 50% ownership.
Oh, interesting. That's sort of like the reverse of what other places I've seen do.
Exactly.
Oh, interesting. Okay. So would it be a similar, so say you set that up with a rental property, you could have all of your expenses for that rental property come from that account, keep everything nice and neat and tidy and separate at tax time, and even just for your own sanity, I suppose.
Yes.
Correct. I ask because I have rental properties, and you have to create these elaborate systems sometimes just to stay sane. So that sounds like a really good way to do it.
Definitely.
Now, so is there a monthly fee for the sort of savings checking portion of the account?
Yeah. So for the Manulife One, there's a monthly fee of $16.95 or $9.95 for seniors 60 plus. And, if you look out in the marketplace, the majority of the banks do charge a service charge. So 16.95 is right in the range. And we do charge that because we're giving you full service banking.
Right.
So you do get a checkbook. You have really excellent online banking app, access to the exchange network for all the cash machines. So it really is an all-in-one type account. Now, you can avoid the $16.95 by applying for our Manulife cashback card.
Okay.
The first year annual fee is free, and we'll waive the $16.95 for a year.
Oh, wow.
And then on occasion, we do have cashback promotions, and cashback promotions typically run up to $4,000. So you could, with that cashback, would cover your Manulife fee for the whole 5 years of your term.
Okay. What else do you get with the account? Checks? Is there unlimited transactions, that sort of thing?
Unlimited transactions.
Okay. And then can you get checks? Can a person write a check with these?
So you'll get a welcome call, then you get a welcome package, which includes free checks.
Okay, cool. Okay. And one more thing, Manulife's sort of known for being one of the lenders that has right of survivorship. We didn't cover that. Can you explain what that is?
Yeah. And, so it's interesting. So 1 in 3 Canadians is between the ages of 45 and 64. So this is the perfect product for this type of client to set themselves up for success in retirement. And when you talk about right of survivorship, what that means is if something were to happen to one of the applicants on the mortgage, the title and mortgage automatically revert into the remaining person's name. Whereas with any other bank, the remaining person actually has to re-qualify for the mortgage. So now, let's say this person is retired, their income is reduced. So the limit or the HELOC that they currently have is either going to be canceled or clawed back, which can put someone in a very precarious situation, maybe even having to sell their home.
I think most people don't even know that.
No, they don't.
Okay. And so Manulife gets around that by having right of survivorship.
Yes. And we were the only bank that offers that.
Okay. That's awesome. Anything else you want to say about Manulife?
So if I just go back to this 1 in 3 Canadians that are between the ages of 45 and 64, we're finding that people are wanting to stay in their homes a lot longer now. They're living longer and they're wanting to stay in their homes longer. So, there's a real opportunity in your peak earning years to tap into that equity so that you have access to it when you retire. And it's much better than a reverse mortgage. First of all, the interest rates are quite a bit higher. There's less flexibility around how you use it. With the Manulife One, you use it or don't use it. And as long as there's room in the limit, there's no minimum payment due. So the fixed portion and the interest rate just come out of the main account. So no payments are required. Okay.
Can you make the HELOC portion readvanceable? So every time you're paying down the principal, that limit on that HELOC is growing.
Yeah, that automatically happens with every payment every month. So it's not like with some banks, you actually have to request it at the end of the year.
Yeah.
With us, readvances every month.
So for an investor, for example, as they're growing the equity in their house or their rental, they could theoretically be at the same time. Well, not theoretically, they would be saving more potential, not money, but borrowing capacity to put as a down payment on the next rental property. So a person could really use that to sort of multiply their portfolio. Okay. All right. Great. I think that's it. I think we covered everything.
I just want to finish off with just, in this high interest rate environment, Canadians are rate sensitive, and I get that. The best rate doesn't always mean what is best for the client, though. I read a statistic a while back that said 83% of Canadians will break their mortgage before their term is up, which is pretty scary. Because let's face it, life happens.
I've seen it. Yeah. I see it all the time.
Yeah, life happens. So you need to know what the potential cost will be to get out of that mortgage. There are different ways to calculate this, as you know, and it could result in penalties costing clients thousands of dollars more, particularly in a declining interest rate environment, which hopefully we're going to start to see in the next 12 months. Yeah. And that's why it's so important for clients to talk to professionals like yourself when they're wanting to either purchase or to refinance a property.
I always add to that stat that 100% of people think that they're not going to break their mortgage.
That is very true. And you just don't know.
Yeah. The unforeseen things happen all the time. And I've broken mortgages before that I didn't think I was going to break. So there you go.
Yes.
Yeah. All right. Well, thanks, Janice. That was really great.
Thank you so much for having me.
Yeah. We might have to have you on again. This went really well.
That's it. I'd love to. Call me anytime.
Okay.
Okay. Take care.
All right. Well, have a good day. Take care, Janice. Okay. Bye-bye. So in summary, the Manulife One works because the money you have sitting in your bank account after every payday is offsetting the interest cost on a daily basis. So let's say your paycheck is $2,000. For the few days or so that it's sitting in your account, your overall debt is $2,000 less. So your overall interest cost is lower. This doesn't seem like a lot of money, but over the course of many years, sometimes decades, this can add up to huge savings. Have you ever heard about accelerated payments shaving a few years off your mortgage? This is like accelerated payments on steroids, right? Because it's almost like accelerated daily payments. But like we spoke about on today's show, if you're the kind of person that spends every last cent within a few days of getting paid, or maybe you need that to pay all of your bills just to get by, we live in an expensive market here, and this is probably not the product for you. If you're managing to save a little bit every month, then the Manulife One can absolutely help you achieve your financial goals quicker. This isn't an opinion, this isn't speculation, it's just math. I'll include a link to a calculator in the show notes, and you can use this to see if this is the right product for you. If you'd like to learn more about this product and how it can help you pay off your mortgage faster, you can reach out to me anytime. Well, not anytime. Don't call me at like 2 a.m, obviously. But you can reach out to me most of the time at www.nathandemers.ca, and I'll be happy to crunch the numbers with you. That's it for today's show. Thank you for listening to the Sunshine Coast Real Estate Podcast.
This is an I Love Mortgage Brokering production.